Alright guys, my name is Shervin. Welcome to my channel. In this video, we're going to talk about the best dividend stocks that you can invest into today. Now, dividend stocks are stocks that pay you a dividend every single quarter. And by investing into dividend stocks and holding them for the long term, you can build yourself a nice source of passive income. This could specifically be advantageous for you later on in life, when you've been building your portfolio over all these years, accumulating all these dividend stocks, and then later on when you're retiring, you have a nice source of passive income throughout your retirement. Now, of course, there are a lot of different options out there when it comes to picking a dividend stock to invest into. But what you want to look for is a dividend stock that pays you a good amount of dividend every single quarter, but also has a slight amount of growth, or at least is stable over the long term. Because what you don't want is a stock that pays you a good amount of dividend, but goes down in value over time. That could be a huge problem for you if you're investing for the long term. So you want to pick companies that are stable, that you know are going to be around 20, 30 years from now, but also give a good amount of dividend every single quarter. Now, if you watch till the end of this video, I'm going to walk you through which dividend stocks I like investing into, why I think they are good investments, and how you can go about investing into the same stocks. But of course, there's one important thing that you need to do before you invest into any of these, and that is to smash the like button down below for the YouTube algorithm. Also, if you haven't subscribed to my channel yet, I make 3 new videos a week on personal finance and investing, and by subscribing to the channel, you get to see all those videos right as they come out. Also, every subscriber makes a big difference for me, and I really appreciate your support. Now let's talk about the first Canadian dividend stock that is a more than worthy investment, and that is Canadian Utilities. Now, the great thing about Canadian Utilities is that it is one of the largest utility providers throughout Canada. And no matter what is happening around the world, no matter what is happening with the markets, everyone has to always pay their utility bills. And of course, that means there's a very low chance of this company seeing a massive dip in their profits or be put out of business anytime in the foreseeable future. Now, this is fantastic news for us as investors, as it means that there's a very low chance of this company going down in value, so we can reliably invest into this company for the long term. Now, this stock also offers a decent dividend payout rate of close to 5% a year. And given the fact that dividends are paid out quarterly, it means that you need at least 81 shares of this stock if you want to qualify for the Dividend Reinvestment Plan, or DRIP for short. Now, if you're not familiar with what a dividend reinvestment plan is, then make sure to check out my video where I explain fully what it is, why it is so beneficial for you as investors, and how you go about setting it up on your own investments. Now, the next stock is another utility provider, and this one is called Enbridge. Now, similar to Canadian Utilities, Enbridge is also a great long-term investment, as it is extremely unlikely that it'll go out of business anytime in the foreseeable future. Now, when you compare it to Canadian Utilities, Enbridge does offer a considerably higher dividend payout rate of about 6.71% a year. However, it is shown to go down in value from time to time. In fact, if you look at the graph over here, you can see it's been a lot more turbulent over time, and there's been a lot of highs and lows throughout the company's history. That said, it is important to note that it still has an upward trend in the long term, so it shouldn't be that big of an issue, but it definitely is a slightly riskier investment compared to Canadian Utilities. Now, given the 6.71% dividend rate and the fact that dividends are paid out quarterly, you need at least 60 shares of this stock to qualify for a DRIP. So perhaps it will be best to get enough to qualify for a DRIP, but not much more, as it is slightly riskier than the other dividend stocks that we're going to talk about in this video. Now, the next 2 stocks we're going to talk about have slightly lower dividend rates compared to Canadian Utilities and Enbridge, but they are still worthy investments as they have a decent amount of growth over time alongside their high dividend rates. Now, the first one is TD, which is the largest bank in Canada, and as a result is a very stable and secure investment. Now, TD stocks offer a 3.56% dividend rate, which means that you need at least 113 shares of this stock in order to qualify for a DRIP. Now, the dividend rate of the stock is lower than the other ones we just talked about, and as a result of that, you need even more shares of the stock in order to qualify for a DRIP, which could mean that this might be a little bit of a tougher investment for you to get into if you're a beginner out there, but it is definitely worth it. And especially if you look at the tremendous growth that this stock has had over the years, you can see how worthy of an investment it is. Now, last but not least, we're going to talk about BMO, which is another great Canadian bank that also has a decent amount of dividend as well as a decent amount of growth in value over time. Now, BMO offers a 3.72% dividend rate, which means that you need at least 108 shares of this stock in order to qualify for a DRIP. And again, similar to TD, despite having lower dividends and despite needing more shares for you to qualify for a DRIP, it is definitely worth the investment, as you can see with the tremendous growth in value of this company and of course the dividends going up every single year. Now, it is very important for you to know exactly where to invest into these dividend stocks, and the best place you can invest into them is in your TFSA account. Now, the tax-free savings account, or TFSA for short, is a government-registered tax-sheltered account, which means that it's an account where you can invest into stocks and companies without having to pay any taxes on the dividends that you receive. Now, of course, there's a lot more detail that goes into the TFSA account, and if you're interested in learning about how it works and how you can set up your own account and start using it, I have a full video where I break it all down for you so you can know exactly how to use this account. Now, one more thing you must know is that you shouldn't be investing into these stocks in your RRSP account, even though your RRSP account is also a government-registered tax-sheltered account. This is because the RRSP account is the only account where you're not obligated to pay US withholding taxes on US stocks. So you want to save up all your RRSP room for US investments. But that's about it for this video. Hopefully you guys enjoyed that. Now, as always, if you ever have any questions about any of the stuff that we talked about, feel free to let me know in the comment sections down below. And also feel free to check out my videos on Dividend Reinvestment Plan and the TFSA if you want to learn more about those things. And with all that said, thank you guys so much for watching, and I will see you in the next video. Cheers.